Small cap funds have always been a favorite category of mutual fund investors. And why should not it be? This is the category of funds which have always generated the best returns. So in today's video, we'll do a detailed review of one small cap fund, that is HDFC Small Cap Fund. This fund comes from one of the most reputed fund houses in India, the HDFC Fund House. In the course of this video, we'll look at the basic details of the fund, different type of returns and risk parameters, and also check its risk return graph, as well as funds capture ratios. And in the end, we will conclude whether we should invest in this fund, or if we have already invested, then should we continue our investment or switch to other funds. Hello everyone, I am Dhaval and welcome to my channel DIY Finance. We will start the video with the basic details like AUM, that is total asset under management, which is around 14,970 crores, which is not that high for a small cap fund, while the expense ratio is 0.80%, which is not too high, not too low, and is as comparable to other schemes in the category. The benchmark index, that is the reference against which the scheme is compared, is S&P BSE 250 Small Cap TRI. So now let's look at the sector-wise allocation. From the graph, it is very clear that the fund has the highest allocation in service sector, followed by finance, capital goods, chemicals, automobiles, and technology. And when compared to its benchmark, its allocation is quite different, except for the chemical sector. Now let's look at the top holdings and portfolio allocation. First Source Solution, the Great Eastern Shipping, and eClerx Services are the main stock of the service sector, whereas Bank of Baroda and HDFC are from the financial sector. Sonata Software is from the technology sector, whereas Bajaj Electricals is from the consumer sector. Here, the stock selection seems quite good, and most of the stocks are having a good PE ratio. Now let's also check the portfolio allocation. On checking the portfolio allocation, it is evident that the small cap shares form around 55% of the portfolio, whereas mid cap shares form other 40%, and only 5% is allocated to large cap stocks. With the above allocation, the fund should be able to generate better returns, but with a little more volatility. The same we will see in the risk parameters also. There are in total 73 stocks in the portfolio, with top 10 stocks making 32% of the portfolio and top 3 sectors making around 46% of the portfolio. With such allocation, though the number of stocks are good, there is always a sectoral concentration risk, as top 3 sectors makes almost half of the portfolio. The portfolio PE is 14.97, whereas portfolio PB is 2.07. Both the PE and PB are okay, and the portfolio seems to be little undervalued, which is quite good and can expect a good upside from here if the market moves upward. There are other factors also to be considered before concluding whether the stocks are overvalued or undervalued. But broadly, we can assume that stocks with lower PE and PB are generally considered undervalued. Now let's also look at the fund manager. Mr. Chirag Shetalwad has been managing the fund since June 2014, that is almost since the inception of the fund, and that too very efficiently, and hope that he continues in future also. Here, this long-standing association of the fund manager with the same scheme is quite positive and an advantage for the scheme. Now let's look at the returns. Firstly, the trailing returns. On comparing the trailing returns for 6 months, 1 year, 3 year, 5 year, 7 years, and 10 years, it is able to beat the benchmark for all the times in the category for almost all the times. May not be with very high margin, but the fund has been able to outperform for the entire period, which is quite good. Here, if you observe, the performance of the fund is quite good in the period 1 year and less. Now let's also check the calendar returns and see how the fund is consistent in its performance. Here, we have the calendar returns from 2014 to 2022, that is 9 years, and the fund is able to beat its benchmark 6 out of 9 years and its category 4 out of 9 years, which indicates that the fund is not that consistent in its performance. Here, the year of 2021 and 2022 has been quite good for the fund, which is also evident in the trailing return section. Now let's quickly look at the fund's performance for the year 2023. Here also, if you observe, the fund's performance has been better than its category and benchmark for most of the times in 2023, which is quite good for a fund. Now let's look at the rolling returns. Here we have rolling returns for the period 1 year, 3 year, and 5 years. For 1 year period, the fund is able to beat its benchmark 72% of times, whereas for 3 years period, it is able to beat its benchmark 91% of times, whereas for 5 years period, it is 100% of times, with zero negative returns. Surely, this performance is quite good, but not one of the best in the category. Hence, it can be concluded that for a longer investment horizon, the fund's performance is quite good, and chances of negative returns is not there if investment horizon is 7 years and more. Now let's see how the fund performs on risk parameters. Here, we compare the parameters with the benchmark index and the category average. First one, the mean return, that is, the average return in a year, which is 40.74 and is more than both the category average and the benchmark. Here, higher the value is better. Second one, standard deviation, that is a tool to measure how much the return has deviated away from the mean return, which in this case is 19.61 and is less than the index but more than the category. Here, lower the value is better. Third one, Sharpe ratio, that is a tool to measure the risk adjusted return, which is 1.88, which is more than the benchmark index and the category average. Here, higher the value is better. Fourth one, beta, that is the volatility of the scheme compared to the benchmark, which is 0.91, which is more than the category average. Here, lower the value is better. Fifth one, alpha, that is a tool that measures how much better the fund has performed compared to the category. Here, it is 6.54, which is little less than the category average. Here, higher the value is better. Hence, it can be concluded that the fund is able to generate better returns than its benchmark, but with a higher standard deviation than the category. Now let's see the upside and downside capture ratios. The upside capture ratio is the measure of how the fund performed relative to the index during the period when the index rose. Here, the value is 98, which indicates that the fund underperformed 2% than the index during the rise period. Here, higher the value is better and should generally be more than 100. The downside capture ratio is the measure of how the fund performed relative to the index during the period when the index has dropped. Here, the value is 66, which indicates that the fund declined 66% as compared to the index during the fall period. Here, lower the value is better. In this case, the upside capture ratio is quite poor, but the downside capture ratio is good. But for a fund to be excellent in performance, it should have both the capture ratios good. Hence, it cannot be considered an excellent fund, but nor a bad fund. Now let's see the risk return graph. Here, on x-axis we have standard deviation, whereas on y-axis we have total returns. It is evident from the graph that the fund has a better total returns value with more standard deviation as compared to the category average and the benchmark, which indicates that the fund has been able to generate better returns with more volatility as compared to the category and benchmark. So now coming to the conclusion, what investors should do. But before concluding this video and suggest what investors should do, I would request all of you that as you have watched the video till now, it seems that the topic is of your interest. Hence, I would request all of you to press the like button and also subscribe to my channel if you have not done till now to watch such interesting videos in future also. So coming back to the conclusion, what investors should do. First, the existing investors. This fund is quite an old fund coming from a reputed fund house like HDFC and also has been performing good. And especially last 1 year, its performance has been improving. So I don't feel existing investors should be much worried and can continue their investment in this fund. The volatility of the fund is little higher, but it is okay for a small cap fund to be volatile till it is able to generate good returns. Second, the new investors. They can start new investment as it's a good performing fund and the performance has also improved in last 1 year. Hence, one can think of starting new investment if you are satisfied by the performance of the fund. I mean to say, this is no way a bad fund, but it is an average performing fund. But there are other better options available in the market like Quant or Canara Robeco. I would like to add that I do not have HDFC small cap fund in my portfolio and do not plan to add this fund in my portfolio as I already have other small cap funds in my portfolio I will again try to review this fund after 6 to 7 months and check its performance. So stay tuned to my channel. To check my older videos, click the attached cards. Thank you.